You know, in the world of currencies, there's always this constant tug of war. And today, we are diving deep into a classic matchup, New Zealand's Kiwi against the US greenback. We're going to look at what's pulling these currencies in different directions and figure out which one might just be about to get the upper hand. Let's get into it.
So this is the big question on everyone's mind, right? After taking a bit of a hit, can the Kiwi actually find its footing and stage a comeback? Or is the greenback just too strong right now? That's exactly what we're here to break down.
Okay, let's just get right to the point. The main idea here is that, yeah, the Kiwi could rally up towards that 0.6050 level, but, and this is a huge but, it all depends on the US dollar taking a breather. If the dollar stays strong, well, that risk of the Kiwi falling is very, very real. This single sentence really sets the stage for everything we're about to unpack. So here's how we're going to tackle this. We'll start with the tactical outlook right now. Then we'll get into the weeds of the Kiwi's economy before jumping over to see what's driving the US dollar. After we compare them head to head, we'll map out a few ways this could all play out and wrap it all up with the final bottom line.
All right, first up, the Kiwi. If you really want to understand what makes a currency tick, you have to get inside the mind of its central bank. And let me tell you, the Reserve Bank of New Zealand is not being shy about its intentions right now.
This one number, 3%, tells a huge part of the story. That's the official cash rate, or OCR, set by the Reserve Bank of New Zealand. But here's the thing about currency markets. It's not just about the rate itself. It's about the direction it's headed. And that's where things get really interesting.
See, the RBNZ didn't just cut rates by 0.25%. They went a step further and basically shouted from the rooftops that more cuts could be on the way. In the trading world, we call that a dovish stance. And for a global investor looking for the best return on their money, what we call yield, this makes holding New Zealand dollars, well, a lot less attractive.
The next piece of the puzzle is the job market. And over in New Zealand, unemployment has crept up to 5.2%. So why should you care about this number? Well, a rising unemployment rate means there's what economists call slack in the system. When fewer people are working, there's less pressure for companies to hike up wages, and that in turn helps keep inflation in check. This gives us a perfect window into the RBNZ's thinking. With inflation not looking so scary, they have the green light to keep cutting interest rates to give the economy a boost. But it's not all doom and gloom for the Kiwi, not at all. You have to remember, New Zealand's economy is massively dependent on dairy exports. And just recently, the dairy giant Fonterra actually raised its price forecast. This strength in a key export is basically acting like a safety net or a cushion, preventing the Kiwi from falling off a cliff. It's a really important supportive floor. Okay, let's hop across the Pacific and look at the other half of this equation, the US dollar. Because right now, its destiny is pretty much in the hands of one place, the Federal Reserve. And wow, the difference is just immediate. Forget 3%, the US Fed is holding its key rate in a much, much higher range, 4.25% to 4.5%. That's a huge gap. So unlike New Zealand, the Fed is kind of playing it cool, holding rates steady because they're still worried about inflation. But Fed Chair Jerome Powell has cracked the door open for potential cuts if the US job market starts to look a little shaky. This makes every single economic report a huge deal, especially this Friday's PCE inflation data. That's the one the Fed really watches, and the market is absolutely hanging on every decimal point. Okay, so we've looked at both sides of the coin. Now, let's put them in the ring together, head to head, and see where the real advantage is. When you lay it all out like this, the picture becomes crystal clear, doesn't it? New Zealand, lower interest rate, a central bank that's actively cutting and a slowing economy. The US, a much higher rate, a cautious central bank, and an economy that has everyone glued to their screens for the next data point. This difference is the fundamental engine driving this entire currency pair. And this chart really visualizes what that policy difference means in real money. Simply put, an investor gets paid more to hold a 2-year US government bond than a New Zealand one. That extra payout is what traders call positive carry. Right now, that's a 60 to 70 basis point advantage for the US dollar. That's a powerful magnet pulling money towards the greenback. So how are people actually betting on this? Well, right now, speculators are slightly net short the Kiwi, which is just fancy talk for saying more people are betting it's going to go down. But here's the twist. It's not an overly crowded trade, and that creates a fascinating risk. If some unexpectedly good news hits for the Kiwi, all those bettors would have to scramble to buy back their positions, which could cause a really sharp, sudden pop higher. That's what we call a short squeeze. All right, we've broken down where things stand right now. Let's shift gears and look ahead. How could this whole thing actually play out? Based on everything we know, we can kind of sketch out three main possibilities. Our base case, the most likely outcome, gives a Kiwi rebound about a 45% chance. But there's still a very real 35% chance things go south for the Kiwi, and then there's a 20% outside shot at a really big, bullish breakout. So let's quickly run through them. The base case gets triggered if we get a nice soft US inflation number, which would let the Kiwi bounce back. The bearish case? That's what happens if inflation comes in hot, pumping up the dollar and shoving the Kiwi down. And that long shot bullish case? That would need a perfect storm, like a surprise rate cut from the Fed, plus some great news out of Asia. So get your calendars out. The first big domino to fall is this Friday with that all-important US inflation report. After that, keep your eyes on the dairy auction on September 2nd, New Zealand's GDP data on the 18th, and then the next big meeting for the RBNZ on October 8th. Any one of these could be a major market mover. Okay, that was a lot. Let's distill it all down to the absolute must-know takeaways. What's the bottom line here? So let's sum it all up. The Kiwi has some short-term bounce-back potential, but, and you've heard me say this a lot, only if the US data plays along. Fundamentally, with the RBNZ cutting rates and the Fed on hold, the US dollar just has the upper hand. The real engine here is that interest rate gap between the two countries, and the one thing stopping a bigger slide, good old dairy prices, which are providing that crucial support. And that really brings us to the final critical question. We pretty much know what New Zealand's central bank is going to do. So is this Friday's inflation report from the US going to be the spark that finally ignites the Kiwi's next big move? The entire market is waiting to find out. Thanks for digging into this with me today.